Max Wasserman is Senior Portfolio Manager at Miramar Capital. So, Max, what's your strategy and take on all of this?
It's good to see you again. I think we have to take a step back and say, look at the multiples in this market and look at all the uncertainty we're facing with fiscal policy and potential monetary policy. I mean, you just mentioned Walmart. You're looking at a company that was trading at 40 times earnings. Even though it's done a wonderful job, I mean, how much more can these things grow? And we're priced for perfection. So we think if you look at the market trading at roughly 26 times earnings, with a 10-year at 4.5%, that could go easily up to 5%. And you have a Fed policy that's telling you we're not ready to keep cutting at this point. We're concerned about everything. We think people are paying too much for these higher multiple stocks and paying way too much for momentum, and it could turn a heartbeat.
I thought it was interesting. So, Max, a lot of what investors are trying to do is look for opportunity. Is it risk from a lot of the Trump stuff? Is it opportunity? And you see opportunity in the defense stocks.
I do, because I'm looking more than 3 to 6 months out. I mean, again, we're dividend growth investors. If you can buy a company like Lockheed Martin, trading at 16, 17 times earnings with a 3% dividend yield growing, and with stocks trading near its 52-week low, we look out a year or two. Can we make 20, 30% on this stock from here? And we can. We also look at some of, like General Dynamics. These stocks have been hit because the potential cutback from Doge and what Elon Musk may or may not do. If you look long term, does anyone believe that the world's going to easily get safer and that we're not going to need defense spending? I disagree with that, but everybody's overreacting. So if you look more than 3 to 6 months, we think there's a lot of good value here, especially when the market's trading so high.
And I should mention the Lockheed CEO is going to be on next hour with Morgan. We're very much looking forward to that. But in the meantime, the flip side of your point is that the cuts aren't going to be that real or substantial. So that makes me want to be careful with bonds. That makes me worry about the deficit, right? That makes you think about high interest rates. That makes you think about the fallout from all of that.
Correct. So we think, we say de-risking by, we're looking for companies that are trading 15, 16, 17 times earnings. Now, we have investments in the large cap growth stocks, the Broadcoms, the Apples, the Microsoft. We just think the valuations here are so rich and we've made so much money, this may not be the time to continue to piling into these stocks. Look for those companies that are still growing, that have the potential to give you total return by the dividends, and we like that. So, but we think people should shorten their duration on their bond portfolios, keep it short term, because you could see the 10-year pop right to 5% in a heartbeat. Well, we still like energy as you look on the screen, as you put it up there. EOG, we like the pipelines, and we like some of the industrials here.
I was only going to say that we're hearing kind of similar comments from the Treasury Secretary. He's also not terming out the debt yet. That was in some remarks in an interview today. Steve, would you add any context then around this conversation where it seems half of the world is worried that these cuts are going too far and the other half is brushing them off and investors are kind of caught in the middle?
I'm still waiting for some evidence that there have been actual cuts. I read a lot of stuff on Twitter.
Workforce cuts, layoffs.
Layoffs. I don't believe any of it yet until I see it all. I don't suspect the cuts themselves, the labor cuts, will be meaningful macroeconomically. The spending could be, especially where it might show up. But, Kelly, I've been trying to think about a thought experiment here. Maybe you could play this game with me.
Happy to.
Okay. What would happen? I'm trying to think about the impact of tariffs on the market. What would happen if in the next 5 minutes, President Trump tweeted out, "I've decided not to do any tariffs"?
Maybe I would say we pop 1.5%.
I think that's good for quite a bit on the stock market. Now, the other thing, though, the other side of this, which is so perplexing, and I think gets at the uncertainty here, and this comes from our good friend John Malloy, who's a smart guy, our pro editor. He says, well, but if he said I was going to do 50% tariffs, the market may not move. Because they kind of don't know what to do with it anymore. They don't know to believe it or not to believe it. So it's not trading negatively on it, but I think there's a pretty good chance it would trade very positively if we had a clear sign he was backing off.